Welcome to 5 Barrel Factors, the channel where we break down the 5 key forces shaping global crude oil prices. During week 42 of 2025, the ICE December Brent crude price fell by 7.5% week over week, sliding from $67 per barrel to $62. Here are 5 key factors that influenced crude oil prices over the past week. First, India to end Russian oil buys. President Trump announced on October 15 that India will gradually stop buying Russian oil after Prime Minister Modi assured him of the policy shift. India currently imports 1.6 million barrels per day from Russia, accounting for roughly 35% of its total crude intake. The process of diversifying supply will take several months as India expands cooperation with the United States and other suppliers. The statement came amid ongoing trade tensions, but both leaders highlighted a positive relationship. India's Ministry of Foreign Affairs reaffirmed that energy diversification and stable pricing remain core priorities. Markets reacted quickly. Crude futures rebounded from 5-month lows on October 16 following Trump's comments. The news supported prices temporarily, signaling reduced access to discounted Russian crude and tighter near-term supply. Second, OPEC keeps demand outlook steady. In its October monthly oil market report, OPEC maintained its global demand growth forecast at 1.3 million barrels per day in 2025, reaching 105.1 million barrels per day. Demand is expected to rise by 1.4 million barrels per day in 2026 to 106.5 million barrels per day. Meanwhile, OPEC Plus production climbed 630,000 barrels per day month-on-month in September to 43.05 million barrels per day, according to secondary sources. Non-OPEC Plus supply is projected to grow by 800,000 barrels per day in 2025 and 600,000 barrels per day in 2026, led by the US, Brazil, and Argentina. These trends show that the cartel continues to manage production growth carefully to maintain market stability. The steady outlook and increased output added mild downward pressure on prices, suggesting neutral to slightly bearish effects on crude markets. Third, IEA warns of supply glut. The International Energy Agency's October report highlighted a deepening supply surplus. Global oil demand is now expected to grow by 700,000 barrels per day in both 2025 and 2026, half the pace of the 2010s average. Supply, however, jumped by 5.6 million barrels per day year-on-year to 106.1 million barrels per day, fueled by Middle Eastern production and OPEC Plus output returning online. Crude stocks increased 17.7 million barrels in August, while oil on water surged by 102 million barrels in September, equal to 3.4 million barrels per day, the largest rise since 2020. Analysts warn the imbalance could worsen as seasonal demand weakens. The growing oversupply weighed heavily on sentiment, driving futures lower. Fourth, UK sanctions Russia's oil giants. On October 15, the UK imposed new sanctions on Russia's oil sector, blacklisting Rosneft, Lukoil, and 44 tankers from Russia's so-called shadow fleet. Together, these entities handle about 3.1 million barrels per day of Russian oil exports, roughly 6% of global output. The sanctions also extended to refiners in China and India for the first time, including Shandong Yulong Petrochemical and Nyara Energy. British Chancellor Rachel Reeves said the move aims to cut off Russia's war revenue stream. Between January and September, sanctioned tankers shipped 89.1 million barrels, or 327,000 barrels per day, of Russian crude. The restrictions raised concerns over transport bottlenecks and reduced export volumes. Fifth, U.S. crude stocks rise again. According to the U.S. Energy Information Administration, commercial crude stocks climbed 3.52 million barrels to 423.79 million barrels in the week ending October 10, the highest in 5 weeks. This marked the third consecutive weekly build, though smaller than the 7.36 million barrel increase estimated by the API. Refinery utilization dropped 6.7 percentage points to 85.7%, the lowest since February, as maintenance slowed operations. Net crude inputs fell 1.17 million barrels per day to 15.13 million barrels per day, while downtime averaged 1.7 million barrels per day. Inventories remain 3.3% below the 5-year average but are climbing steadily. Higher inventories and slower refinery demand pressured prices downward. Thank you for watching 5 Barrel Factors. Stay with us for clear, concise insights into the forces driving global energy markets. Don't forget to subscribe and continue following the channel for daily updates.